Well, good afternoon, and thank you for joining me for the Vincent's webinar on the superannuation changes for 2016-17. Now, a couple of things just before I kick off. We're actually trialling a new webinar software this afternoon, so I feel like I'm actually in the bunker of the NRL. I have more screens and computers than I really know what to do with, but we'll see how we go. And you'll also notice that you can see my lovely little picture down in the bottom corner of your screen there. That's so you can, I suppose, be a bit more personable, actually understand who you is talking to you. And secondly, I do have a bit of a croaky throat or croaky voice, so I do apologise in advance. I've got a little glass of water here, so hopefully we can overcome all these little challenges. Anyway, we've got a fair bit to go through today, so they're my contact details. This webinar will be posted up onto our YouTube channel later on, either today or tomorrow. If you have any questions, in the interest of time, if you could just email me directly, please, because we've got a fair bit of content to cover off, and I'm conscious that we might not make it if we have questions along the way. So by all means, ask the questions, but just shoot me an email. That's probably the easiest way to facilitate that, and I'll certainly get back to you. So I don't know if you are like myself, but this is sort of how I feel at the moment with the amount of information that's swirling around in my little head, dealing with all the super changes. These are essentially the largest changes we've had in about 10 years, and arguably the third biggest change we've ever had to our superannuation system, and that includes the introduction of the system. There are lots of new terminologies, lots of new ways in which we need to think about things. So it's all very new legislation. It only was introduced in November last year. The ATO are doing a really good job in putting together what they call law compendium guides to try and help trustees and the industry in how they interpret the law. But the downside is that we're not likely to see all those finalised until end of March or thereabouts as their timeframes. They're also promising that they'll provide some calculators and just general information that tax practitioners such as myself can actually use to help obtain information. Because in the past, we've only ever had to worry about self-managed super as a single entity. We've never had to worry about anything outside of the self-managed fund, for argument's sake, or outside that particular member balance. Going forward, we have this new concept of total superannuation balance, which is everything that the member has inside super, including any CSS pensions, things like that. So there's a lot more information that, as an advisor, we need to obtain now to make sure that we're actually telling the right things. So it's great the ATO are building all these systems and infrastructure for us, particularly given the challenging times that they've had of late with their own systems. So some appreciation to the tax office for doing that is certainly there. So moving forward, what are we going to be looking at this afternoon? So we're going to talk about this new concept called the transfer balance cap. We're also going to have a look at a couple of tax measures that have been introduced. Transitional capital gains is an absolute minefield in a huge area, and asset segregation and what that means and where that is going to now. Concessional contribution caps and the non-concessional contribution caps, there's been some changes with those, so we'll briefly talk about those. Deductibility of contributions, so there's a new measure in relation to that. What's happening to retirement income streams, the catch-up contributions, and then finally, very quickly, we'll have a brief mention about the Div 293 tax and some changes there. Most of this presentation will be focused on the first 2 points. They are the big heavy items, the big ticket items, the most technical area with all these changes. So moving straight through. We've got lots of new concepts around this transfer balance cap notion. So firstly, we have this thing called the general transfer balance cap. Now, this, when everyone talks about the 1.6 million, that's really what they're talking about, is the general transfer balance cap. Now, this cap is going to be indexed in $100,000 increments based on CPI. So reality is we're not going to see any increases in that 1.6 million probably until about 2019-20 financial year. Then we have this thing called the personal transfer balance cap. So the personal transfer balance cap is where an individual sits within inside that 1.6 notion. So for argument's sake, if I start a pension today on $1 million, I have used up $1 million of my personal transfer balance cap. I still have $600,000 left, assuming that the general transfer balance cap is 1.6 million since I did it today. Then we also have this notion of a transfer balance account. So this is the account balance that counts towards the personal transfer balance cap. The highest transfer balance is basically the highest transfer balance account that an individual has used at any point in time, irrelevant of indexation. That's relevant for indexation purposes. We have a concept called an unused cap percentage. So that's how much is being unused from when you start a pension to the general transfer balance cap, or the personal transfer balance cap, I should say. And then, as I mentioned before, a total superannuation balance. I'll be going through some examples to sort of explain how all these mechanisms essentially, or at least terminologies, interrelate. So I'm not just throwing terminologies out there, we'll actually give some examples of what it means. Now, the first thing to mention is that the transfer balance account is made up of certain things. Typically, that will be made up of an accumulation balance or a pension account balance. So it's quite straightforward. It's your normal account balance that you see in your member statement. Contributions in, interest, less expenses, that's the balance. However, defined benefit funds don't actually work like that. How they're actually structured is they're based on a formula. So the income the pensioner receives is based on a formula. So to try and assign a value to that actual defined benefit arrangement or that defined benefit pension, what the government actuary has said is, okay, well, that value will multiply by 16. Now, that applies to your lifetime complying pensions, so your CSS pensions, for argument's sake. However, if you have a market-linked pension, or if you have a fixed-term pension, or one of those type of pensions, then it's actually based on a life expectancy calculation. So once again, it's formula-based, but you actually have to look at the life expectancy tables. Now, I'm not going to go into a lot of detail around these because typically there's not a lot of them, but it's certainly important to know, particularly around those CSS pensions, because I've discovered only in the last couple of months that a lot of our clients have these type of pensions, and they're very simple. Essentially, you annualise the pension amount and multiply it by 16, and that's the value that's been assigned to that pension. Then we have what counts towards the transfer balance account, so or transfer balance cap, so the credit side of things. So when you start an income stream, at 30 June 2017, that's counted towards your transfer balance cap. Now, as I've just mentioned there, TRISs or transition to retirement income streams are not treated or not deemed to be an income stream or retirement account under these new measures. And I will talk about that a little bit later on. The capital value of any new pensions that are commenced after 1 July 17, any reversionary pensions. So a reversionary pension is basically on death, a member is in receipt of a pension, and as part of the original paperwork, as part of the contract that they entered into at that time, what they've actually done is they've said, I want my pension to become my spouse's pension on my death. So what they've done within these new rules is they've said, okay, well, that reversionary pension will count towards the spouse's transfer balance cap or personal transfer balance cap. So that's a really important thing, because you've got some limitations essentially as to what you can do. There's no discretion there. It automatically throws through to the spouse. However, the spouse has 12 months to decide what to do. So they can elect to remove that money out of superannuation completely, or they can use it as a pension for themselves. However, there's some tricks that need to be applied there, because you have to be under that 1.6 million for the transfer balance cap when you start a pension. So if the spouse isn't already on a pension and the deceased had, say, 1.7 million, then the spouse can have a pension reversion or a pension of 1.6 million, and $100,000 has to leave the superannuation environment. So these measures are really about removing the estate planning toolness, if you like, that's such a word, of superannuation, and moving it out into a higher taxed environment, so into the personal names. That's essentially what they're trying to create by having, by removing the estate planning aspects with these new pension caps that they're bringing in. Notional earnings that accrue on excess transfer balance amounts. So in other words, if you start a pension 1.7 million, there's notional earnings that's associated with that additional $100,000 between the 1.7 and the 1.6 million. And those earnings are taxed at 15% for the first error or breach, and then 30% for the second and subsequent breaches. So it's something you really need to be very mindful of, particularly if you have pensions running in different super funds, which I have some clients that do that. So that's a real trap to be aware of. And as with any good accounting system where we have credits, we also have debits. So as far as the debit goes, what reduces down that transfer balance cap, or the personal transfer balance cap, when you basically stop a pension or part of a pension. So if I have a pension and I was started at 1.6 million and I decide to take some money out of that, I could potentially treat it just as a pension amount, or I could say this is a commutation of my pension. So I'm going to take out $500,000 of my pension. My new capital is $1 million. Oh, sorry, 1.1 million. Once again, I've got some examples around this sort of stuff. Personal injury structured settlements are also excluded from the transfer balance account, so they sort of get added in and then taken out. So typical double entry. Ceasing a pension, as I've mentioned, loss as a result of fraud and conviction. So there actually has to be conviction for that to be reduced down. For bankruptcy purposes, family law purposes, the percentage split is reduced down. And also if the ATO or the tax commissioner basically says, yes, you can have a reduction. So there's a process there that you can go to the commissioner and say, hey, can I have a reduction? And he'll say yes or no. So there's that process. So running through some examples, because that's probably the easiest way to sort of explain how this stuff works or will work come 1 July 17. So let's assume that we have Alison, who starts a pension on 1 July 2017 with a pension of $800,000. All right, so well below her cap. Then she commutes $500,000 to a lump sum, and then 3 years later, she puts back in $300,000 and starts a pension on that. So what does that look like from the debits and credits, essentially? So very simply, you can see there that the pension commencement, $800,000 credit, the commutation, the $500,000 coming off that, which means that she's left with a $300,000 personal transfer balance cap that's been used, and then she restarts a pension of $300,000. So now her transfer balance cap is at $600,000. So that means that she still has the difference between $600,000 and 1.6 to start a pension on, assuming the cap is still 1.6 million. Now we're going to sort of ramp up the examples a little bit. So this is where we have the transfer balance cap being indexed. So you might remember sort of at the outset I mentioned how it increases in $100,000 increments based on CPI, and we're likely to see that in around 1920 financial year. So let's assume that Hillary starts a pension of $1.2 million in October 17. And you'll notice there also in the example, I've got the initials or the acronyms behind what different things mean. So that 1.2 million, that is Hillary's highest transfer balance. And that's really important for indexation purposes. So on 1 January 18, Hillary commutes $400,000. So now the transfer balance account has gone from 1.8 down to 400, less 400, so $800,000. However, Hillary's unused cap percentage is only 25%, which is 1.2 million being the highest transfer balance, divide by 1.6 million, multiply by 100, 75%, 100 less 75, lo and behold, equals 25%. So what that means is when the general transfer balance cap is indexed to 1.7 million, Hillary doesn't get the full $100,000. Hillary only gets a $25,000 uplift, being the 25% of that $100,000. Now, it's important to note that the indexation only applies to the difference between your highest transfer balance account and where you start your pension. So in this example here, we're still assuming that Hillary starts his pension at 1.2 million, so that's his highest transfer balance. Then he contributes or rollovers a bit more and starts another pension. So now 1.2 plus 400,000 is 1.6 million, obviously. So Hillary's new highest transfer balance is now 1.6 million. So 1.6 divided by 1.6 multiplied by 100 equals 100%. 100 less 100 is 0. So Hillary gets no indexation going forward. Even if the cap goes up to 1.7, 1.8, regardless, he is stuck at 1.6 for his capital account or his pension account where it starts. Now, I'm talking about all this 1.6, 1.7. The thing to remember is that over time, as the investments hopefully grow that member account, that's okay, because the 1.6 million is in the background. So that 1.6 million can grow to 1.65, 1.75, no problems with that whatsoever, so long as a new pension hasn't been started. As soon as that new pension starts, that's a new amount that tries to lock into the transfer balance account. So we're going to be having a situation where we have two member accounts essentially running, a pension account or the transfer balance account, and then the actual members account. So what are the assets worth? So even if Hillary were to commute $500,000 out of his pension account, that doesn't matter, because his highest transfer balance at one point was 1.6 million. So even though now it's 1.1, makes no difference. That's only for indexation purposes. So if Hillary decides to commute that $500,000 out and have it, take it out personally, and then for whatever reason he puts it back into superannuation, then he can start another pension, but only on $500,000. He can't start it on any more than that. So he can't manipulate the system, so to speak, to obtain that indexation. And example 4. Now, this is really where it gets fun. So let's assume that Peter starts a pension at 1.6 million on the 1st of July. So his highest transfer balance is 1.6 million. So he doesn't get any indexation. On 1 July 2020, his account balance has grown to 1.9 million. All right, so go Peter, it's all good for him. So that's all investment earnings. There's been no contributions or anything like that. But then he decides, actually, I am going to commute my full pension. I'm going to stop the whole thing, and I'm going to take it all out and put it into accumulation. So it's still in super, but it's in accumulation. So now his personal transfer balance account, or transfer balance cap, is negative 300,000, because the 1.9 million that he's commuted out is $300,000 more than what he started his pension on. So that means that at any point in time, he can start another pension up to 1.9 million. So the original 300,000 negative plus the 1.6 million. So if you think about that logically, all it's doing is returning Peter to where he was before he took the money out of super. So logically it makes sense. But when you think about it in the context of how all this stuff works, it sort of does your head in a little bit. So regardless if the general transfer balance cap was 1.7 or 1.8, makes no difference. He still has 1.9, being his 1.6 plus his 300,000. So that's probably one of the bigger measures that they've introduced as part of all these superannuation changes. So if you're still with me, then you're doing really well. Now we'll move on to a couple of the tax measures. So the easiest part of the tax measures they've introduced is asset segregation. So currently we have the ability to allocate certain assets to certain member accounts and potentially obtain a tax benefit for that. So let's say, for argument's sake, you have $1 million in super, $500,000 in shares, $500,000 in cash at bank. If the members have segregated the assets, so all the shares are in the $500,000 pension account, then all the capital gains, the earnings, and the franking credits are all tax-free. Whereas the the earnings that's derived by the other $500,000 that's in accumulation phase, and in other words, the ones that's in cash at bank, any earnings on that goes to the accumulation account and tax is paid on that. So we've been able to do that up until 30 June this year. And we still can, so long as the total superannuation balance of that member is less than 1.6 million and there's no pensions involved. So if you have someone that has over 1.6 million and they are receiving a pension, they can no longer segregate for tax purposes. And this is where it's, for administrators like us, where it's going to become really complex, because we can essentially have investment pools running, which historically we've just called segregation for ease. We can now actually have investment pools running for income and expense allocation purposes, but for tax purposes, the fund is considered as a whole. So there can be a lot of unintended consequences with this. So for argument's sake, if you have business partners inside a super fund, let's say they've got $1 million each, and it's in accumulation phase, that's fine. But one of those business partners has another $1 million in a retail super fund that's paying a pension. What that means is that affects the self-managed fund that the business partners are in, that own their property. So they can't segregate if they want to have different investments in there and things like that. So that's going to be going to mess up a lot of structures that are going on. I've got a client that is just that. Two business partners, they own a property. One of them also has other investments in there. Those investments are segregated for income and tax purposes currently to one member. So going forward, it'll be a case of those assets, additional assets, are segregated to that member for income purposes only, not tax. So that'll be a bit of a nightmare, to say the least, as far as the administration or the accounting of this super fund. Now moving on to probably the second most, or arguably the first most complex area of these changes. And what they're trying to do is to provide some relief for people who are going from what they thought was a tax-free environment. So if you're in pension phase, you're a tax-free environment, you're now being potentially taxed on your capital gains. So what they're trying to do is to say, okay, look, we realise we're throwing you into doing this new measure. What we want to do is we want to provide you some relief. We want to put you in a situation that you're not disadvantaged, essentially. However, doing that, they've created a very confusing system, to say the least, and it will mean that the 2017 year for accountants such as myself will be lots of fun, because we're actually going to have to do a lot more work for certain clients to make sure that we're getting the best result, the tax result for our clients. So these transitional CGT arrangements are only applicable to funds that are paying pension where a member has over 1.6 million. Now that 1.6 million is their total superannuation balance, or if the fund is paying a TRIS. So we've got about I think about 80 transition retirement pension funds here that we look after. So we're going to have to look at all of those clients and look at their arrangements, not to mention the ones that we have that have over a $1.6 million balance. The election for this transitional CGT arrangement is irrevocable. It has to be made prior to the lodgement of the 2017 tax return, and it has to be in the approved form, whatever that actually looks like, because no one knows yet, even the tax office. There's a strong suspicion that it will be another label on the tax return for the 2017 year. Now, depending on the type of capital gains part that you go through, and I'll explain what I mean by that in a minute, you can either, if there is tax to pay, you can either elect to pay tax now, so when you lodge the 17 return, or you can defer paying that tax until you actually sell that asset, which might sound fair enough. But then if you think of it, that the election is actually an asset by asset or even potentially a parcel by parcel election, if you've got a client that has a lot of shareholdings, that's going to be rather challenging to keep a track of, particularly if they're active. They might be reasonably active in their share trading. You're going to have to know, okay, well, this asset here was the one that we deferred the tax on. They've now sold it, so we're going to have to include that capital gain on the tax return that we incurred 6 years ago. So that's going to be, once again, very interesting, very confusing, and a lot of people, including us, are hoping that our software providers will be right on top of this sort of stuff. Otherwise, we'll be keeping lots of manual records and having carry-forward files and things like that, which is obviously the other solution that we used to do. But these transitional arrangements, essentially how they work, it's just like you sell the asset and you buy it back on a particular day. The sting in the tail, so to speak, is that there's no entitlement to the CGT discount for up to 12 months because it is a sale and rebuy. So if you sell an asset, call it on 1 July, you actually, if you sell it within the next 12 months by 30 June 2018, it means that you do not get the benefit of the discount over that 12 months. You have to wait a little bit later. Having said that, discount's 5%. Chances are, if you're looking to invoke this election, you're going to be sitting on a larger unrealised gain than what that would mean. So it'd be crazy not to. And the other thing to bear in mind is that property valuations essentially will be a must come this year, particularly if you're rather heavily weighted in property, for the simple fact that the tax office will be really looking at, okay, how are the values structured? Did you obtain a valuation that got you below 1.6 million? Did you do it so you got one above 1.6 million so you could use these measures? So by having that valuation on file, it means that it's quite clear that you've done everything prudent, that your market values are absolutely as spot on as you can get them. So any uplift in capital gain is essentially unquestionable. So that's why we're suggesting to our clients just obtain valuations. Now, the date on which the cost base is reset is actually the date on which the change is made. So rewinding 5 minutes, when I said that because these changes are being forced onto pensioners, the tax office, Treasury, have instigated this transitional CGT arrangement. So because of this change is being forced on them, therefore they can use these measures. So whatever date that the change occurs, that's when the reset of the market value occurs. So for argument's sake, if that happens to be 1 March, or even let's say it's today, the 21st, of February. So that means that the change happens 21st of February. So our 12-month clock for the discount tax, capital gains tax purposes starts essentially today. So you don't have to do anything on 1 July. You can actually go back and have a look at what dates work best anytime between 9 November and 30 June 17 to see essentially what you do and when you do it. Now, I mentioned before about two paths. So we have a segregated path and the proportional path. Sorry, mental blank. The segregated path is either where the fund is 100% in pension phase, or there is actual segregation going on. So the example I gave before, $500,000 in pension, $500,000 in accumulation, then that's segregated because you have allocated investments to the pension account, you've allocated pensions to the accumulation account. You've allocated assets to the accumulation account. Now, this is only applicable where assets have been segregated, so either 100% pension or actual segregated, between the period of 9 November and it stops at any point up until 1 July 17. So if you decide that you do it today on the 21st of February, then you actually have to own the assets on the 21st of February, and that's when that segregation stops. And you can avail yourself to these CGT measures. The proportional measure method is or path, I should say, is a little bit more confusing. So if you've obtained an actuarial certificate for the 2017 year and it is greater than 0%, and assets have not been segregated between 9 November and 30 June, so in other words, it was never a full pension fund, then you can actually use this measure. So what that means, for argument's sake, is that if you want to make sure that if you have a fund that is part pension, part accumulation, and then say on the 21st of February, we start a pension on the other accumulation amounts, well, now the fund's 100% segregated because it's 100% exempt. So that is the day in which you have to then use these new measures. So we now have to not only consider the timing of pensions, but also the implication that can have on capital gains tax positions, because today might be a bad day to actually start a pension for the market purpose, market valuation purpose. So, yeah, that's basically what this is saying. Really need to be careful that you don't accidentally stop segregating or that you start segregating too soon. So once again, a couple of examples for you. So this is where we have a segregated account. So let's say that Amy has a self-managed super fund, 2 assets, and for simplicity, let's say they're both worth $1.6 million. Solely supporting her account-based pension, which has a value of $3.2 million. Amy needs to partially commute 1.6, so she has 1.6 million in pension and she'll have 1.6 million in accumulation phase. So now she's got 2 accounts running as opposed to just 1 pension account. She has some options. She can essentially do nothing with the assets, just leave them as they are, which means that the fund becomes unsegregated. So for earnings and tax, it's quite simple. Obtain an actuarial certificate and away we roll. However, with option 2, what she can do is she can say, actually, I want to transfer one of the assets to a segregated accumulation pool. So remember, this happens prior to 1 July 2017. It can be 30 June, that's fine, that's still prior. It could be today. So she does that. Then at 1 July 17, the fund is segregated. So that means that we have one asset, one property, supporting the pension and one supporting the accumulation account. So then under option 1, both assets benefit from CGT relief because it's unsegregated. Under option 2, only the asset that's transferred to the accumulation pool is eligible because the other one is still sitting in pension phase. However, from 1 July 17, Amy's fund won't be able to segregate anymore because she has more than 1.6 million. So you really need to be careful as to how that actual mechanism works as far as the administration goes. Now, typically, option one's going to be what people use. It's simple, it's clean, and by and large, it'll give the better result. However, option two is still there, and it still may be better to use that in certain circumstances. So that's just something that needs to be bared in mind. Another example, so using the proportional method. So Carrie is in accumulation and Andrew is in pension phase. They have in a self-managed super fund with a single asset worth $3 million, which they purchased for $2.5 million. So there's a $500,000 gain for the fund on that one asset. Andrew's pension is worth $2 million, so therefore he needs to commute back $400,000 into accumulation. So that way he'll have a $1.6 million pension account and a $400,000 accumulation account. So lo and behold, 1/3 of the gain, because Carrie only has 1/3 of the balance, is notionally assessed. Because this, and we're assuming this all happens at 30 June 17. So that means that $166,000, which is 1/3 of the $500,000 gain, less discount, is a notional tax amount that now carries forward until they sell the asset. So they can either add the $166,000 net capital gain to the tax return, or they can defer it until the asset's sold. Now, for property, that's relatively easy. For shares, that's going to get really difficult, particularly if we come down to parcels. So, so that's going to be a lot of good fun for accountants like myself. So they're the two big ticket items essentially within these changes, and certainly the most confusing. I've done lots of reading on these topics, and there's still, as I mentioned earlier, the ATO is still publishing material. They're still finalising their material. So there's still a bit of water to go under the bridge yet before everyone's sort of locked away as to, okay, this is how it's going to work. Because the tax office is just doing what everyone else is doing, reading the legislation, and interpreting what it means. They obviously have the benefit of talking to the people who wrote the legislation in Treasury to say, is this exactly what you meant? Right, so rolling forward onto the easy stuff now. Concessional contributions. So from 1 July 2017, they will go down to $25,000 for everyone, regardless of age. Right now, it's $30,000 or $35,000, depending on age. This $25,000 will increase in $2,500 increments, and that'll be based on this thing called a WATI, which is the average weekly ordinary time earnings. And that's published by the Bureau of Stats. And so every few years, hopefully, that 25,000 will increase. It'll go to 27.5, 30, and so on. For anyone that's been sort of following along on my webinar bingo over the past number of years, you will know, however, that there has been numerous occasions where the indexation has been frozen, it's been changed, it goes up and down. So anything's possible as far as this goes. Non-concessional contributions. So firstly, the cap for the 2017 financial year, right now, $180,000 per member, or $540,000 to use the bring forward, which is basically 3 years worth of non-concessional contributions from next year and the year after. You can bring it forward into this year. So, but you couldn't have used it in the past 2 years. So firstly, make sure that you haven't actually made contributions that have exceeded $180,000 per member, regardless of the super fund. So $180,000 per member as a non-concessional contribution into super. If you haven't done that over the past 2 years, then you can use the $540,000 bring forward. From 1 July, that cap's been reduced to 4 times the concessional amount, so $100,000. However, you are only able to make non-concessional contributions if the member's total superannuation balance is less than 1.6 million. So if you happen to have $2 million in super as at 30 June 2017, you can put any more money into super. If your balance falls by the following financial year, so it's 1.5 million, then you can put more money into super. However, you can't do the full 300,000. So the challenge here is that for self-managed super fund administrators, if for clients to actually make valid, informed decisions when they want to, they're going to have their accounts up to date. Here at Vincent's, we're actually looking to move to monthly processing, and a number of our clients are actually already started on that journey. So the ideal world for us will become 30 June this year. Nearly all of our clients will be on monthly processing. So that way, whenever you want to make a contribution, you'll actually know how much you can make and when you can make it. So I mentioned the bring forward still available, still 3 times, so $300,000. Now, as I alluded to, the gap between the $1.6 million cap and the total superannuation balance as at 30 June the prior year can only be plugged by $100,000 increments. So if you have 1.55 million inside super and you want to make a non-concessional contribution, you can only put in $100,000. So the bring forward essentially doesn't apply. If you have 1.45 million, you can put in $200,000. So even if you had 1.5999, you can put in $100,000. So that's where that valuation is going to be really important, and that timeliness of having that data as well. So a couple of examples. Kelly has $1 million in super, in a self-managed fund, and 580,000 in a retail fund, as at 30 June 18. So can Kelly actually make a non-concessional contribution? Well, as I've already alluded to, the answer is yes, you can, but only $100,000, no more. Now, as far as the non-concessional caps for this year and the next couple of years go, because the cap is changing from 540,000 down to 300,000, we essentially have a transitional arrangement. So this table is really helpful to explain what that actually means. So long and the short, I'll explain it. In 2015-16, 2016-17 financial years, if a member has put in more than $460,000, they can't put any more in from 1 July 2017 until the 19 financial year. So they can, nothing for 18 year, they can do some more for 19 on the basis that their balance is still less than 1.6 million, or their total superannuation balance is less than 1.6 million. If a member has put in more than $180,000 but less than 460, then they can't exceed $460,000 up until the end of the 2018 year, and then they can go again with the $100,000 or bring forward, 3-year bring forward. If they put in more than $380,000 this year, then they're basically locked out for the next 2 years until the 2020 year, and so on. So the easiest way to think of it, you can see the strip in yellow, gold, whatever you would like to call it, down the bottom. Add those up, and that is where the cap sits. So in other words, I'll pick on the last item there. So more than 180 but less than 380. So the 380 comes from $180,000 for the 17 year, $100,000 for the 18 year, and $100,000 for the 19 year. Add those together, $380,000. So that's essentially the cap. So if they don't do 540 now, we have this scaled or transition arrangement that they need to abide to basically get the amount right. If they get it wrong, then we have excess non-concessional contributions, and it goes through the normal ATO process, although that is being rejigged as part of these measures as well. Always remember that if you have a a member of a self-managed fund that happens to work for the Queensland government. They may have a Q-Super defined benefit plan, and some of those contributions that are allocated to the member will be notionally assessed as non-concessional contributions. So even if they do exactly 540 inside the self-managed fund, you still may have problems. And unfortunately, we don't have a lot of clarity as to what those numbers are unless we physically call the tax office and ask the question first. So an example on that, transitional non-concessional contributions. So say Miranda has $1 million and her total superannuation as her total super balance is at 30 June 16. She puts in $250,000 during the 17 year. So in other words, she's triggered a bring forward because 250 is greater than $180,000. So that means that Miranda can put in another $130,000 over the next 2 years. So in other words, 180 plus 100 plus 100 equals 380,000. Take away the 250,000 means you're left with $130,000 left. So that's how that works. So Catherine has 1.35 total superannuation balance as at 17. So her gap is $250,000. She could actually contribute $300,000. However, if she contributes $150,000 in the 18 year, and trigger a bring forward, she's made $25,000 concessional contribution and her balance has grown to $1.605 million come 30 June 18, then she can no longer put contributions or non-concessional contributions into super. She can still make concessional contributions where a tax deduction is claimed, but no non-concessional contributions. So once again, valuation is going to be very important for those people that are around that 1.6 million if they want to put more money into super, if they want to start money on their pensions, things like that. Deductibility of contributions. This is a real pleasing element of the changes. So from 1 July 17, this notion that we currently run with of a 10% test will no longer apply. So in other words, as an employee, if my employer pays in $15,000 into my super fund, I can personally dip into my back pocket, put another $10,000 in and claim it as a tax deduction in my personal tax return. So the source of where it comes from is irrelevant. The amount of times that we've had salary sacrifice arrangements have all gone a bit skewy because of the timing of when contributions are made, and it throws everything out. That essentially won't apply anymore. It's giving the power back to the individual to get it right, not relying essentially on a third party to do it for them. So I think that's a really good thing. And that will certainly make accountants' lives a little bit easier because they're not having to assess, do they meet the 10% test or don't meet the 10% test? Now, remembering that that's for the 2018 financial year. So we still have one more year of that fun. Transitional retirement income streams. So essentially, these are no longer pensions under the new system or retirement accounts. So what that means is they're treated exactly the same as accumulation balances, except you're able to still pull out your pension amount. So earnings will be taxed at 15%. Capital gains tax on the assets supporting that pension will be taxed at 10% if they're held for more than 12 months. So essentially, no longer will there be a tax deduction for running a TRIS like we have today. And also we can't treat pension payments as a lump sum anymore either. So that was a little strategy that we could use to bypass some tax. We can't do that anymore. So essentially, to change from a transitional retirement income stream to an account-based pension, the member needs to satisfy what's called a nil cashing restriction condition of release. So in other words, they're able to access all of their super. And I've put the four of the main opportunities there. I haven't included death because that's something you can only use once, and typically it's not a condition of release that people are fond or keen to use. So basically turning 65, permanent incapacity, terminal medical condition, or obviously retirement. So any of those four, or death, means that your super money is fully available. It meets that nil cashing restriction condition of release, so an account-based pension can be started on that on that amount. Unused concessional contribution caps. So from 1 July 2018, the unused concessional cap can be clawed back for up to 5 years. Now, providing the member has less than $500,000 in super at 30 June for the year before. Now, the big thing here is this is a clawback. It's not a bring forward. So what that means is you won't actually be able to use this mechanism until fully until basically 2023, because you have a look at the 2023 year, 22, 21, 19, 18. So 5 years. So you actually go backwards. And you can't have actually used, and remember it's unused contributions. So if you have contributed $20,000 over that time, it means that then you have another $25,000 that you can use in 1 year, because $5,000 by 5 is $25,000. So that's a good in theory one. Also remembering that your balance has to be less than $500,000. So the planning around that, I think, is really tricky and really dangerous to get wrong. So to me, that's a little bit of a nicety, but the practicalities of it from a planning tool are limited, unless, of course, that you've got someone who has small balances and they have investment properties outside of super. They're going to make a capital gain on it. They sell those. They can then claw that back and get a tax deduction for it. And then finally, the Div 293 tax. So basically, the threshold is being reduced from $300,000 down to $250,000. So that means that if you have an adjusted taxable income of $250,000, you're up for another 15% tax on your contributions. So adjusted taxable income is basically where you have your contributions, taking off any negative gearing or investment losses, and adding on contributions. So there's a bit of a formula that works in there. So just something to be aware of, that may apply if you have more than $250,000 in that category, whereas before you might not have had to pay it. So there we go. So that's basically the super changes at a high level, under an hour. Now, obviously, there's lots of detail to it, particularly around the transfer balance account and the transitional CGT arrangements. By far, they're the most confusing areas, and I've been seeing clients essentially on a daily basis around what they mean and how they work for them for the last few weeks, and I will consider that will still occur for a little while going forward. So that sort of ends the webinar for this afternoon. Thank you very much for your attendance. By all means, if you have any questions, please email me, bgriffiths@vincents.com.au, as per the beginning of the slide, but also in the chat box there, you should be able to see that there. So with that, I will thank you for listening, and have a great afternoon. Thanks very much. Bye-bye.